In the next 4 minutes and 31 seconds, I'm going to reveal for free the exact secret that allows you to instantly copy massively successful forex traders and start profiting today. But first, I guess you already know that there are people making millions of dollars online through forex trading. The trouble is, none of them want to teach you how to trade yourself because 1. It takes years and years of trial and error, research, training, trading, losing, and blowing of accounts to get to a standard where you can consistently make large amounts of money. And 2, why would anyone that has reached this level want or need to teach you when they are already trading profitably day in and day out? You see, the secret to bypassing the years and years it takes to become profitable in forex is to copy an already successful trader. But not just any trader. A trader that has a proven track record and, most importantly, does not stand to gain financially from the amount of trades he places or the amount of risk he takes. You need to copy someone that is 100% impartial and only makes money from his successful trades. You see, that's the trouble with most trade copying services. There is always a conflict of interest working against you to make you lose. Let's take Zulu Trade for instance, a very well-known trade copying website. What makes them so bad, even though the service is free, is that the signal providers on there are compensated for every trade they make. This means that, although they are trying to make money to gain followers, they are also trying to open as many trades as possible and rake in the maximum amount of commission for themselves. Inevitably, this leads to overtrading, huge amounts of risk being taken on, and eventually, when they do experience a losing run, their losses are multiplied, causing every account that is following them to become instantly decimated. It's really a huge conflict of interests when the person whose trades you are copying is actually being compensated for each and every trade they make. More worryingly, a huge amount of the accounts on Zulu Trade are demo accounts, and as everyone well knows, nobody trades the same on a demo account as they do when risking their own hard-earned money. So again, huge risk and multiple lot sizes are taken on by the trader, safe in the knowledge that if they do blow their account, they lose nothing. And if they happen to get a lucky winning streak, then they are compensated for their trades. Clearly, copying traders from Zulu Trade is a flawed plan from the start. Next, we have people that sell their trade copying software, claiming that there is a successful million-dollar trader behind the scenes trading away for you. Now, firstly, why would anyone that can trade consistently profitably want to sell their system for a mere $47 when they are making millions already? It's simply not worth their time. Secondly, do these people ever show you their own real money accounts trading the same exact signals? I think not. The signals almost certainly come from a demo account where they are not actually risking any money. They take your $47 and after that, couldn't care less if you win or lose. Do you see now why I say there is almost always a conflict of interest when copying other people's trades? Until now, that is. Because there is another way. A secret method that almost nobody knows about. A method where you can copy successful traders for free, and most importantly, because they don't earn a dime from it, with no conflict of interests. The best part is, they actually care if they win or lose, because it is their real money that they are trading with. They don't take huge risks or open up hundreds of trades commission hunting. But they do make consistently large profits, and now you can too. Some of these traders are earning millions of dollars per year while risking only a tiny percentage of their account. These are the real professional traders who do this day in and day out for a living, and the very people whose knowledge and trading expertise is normally off limits. Now, I must stress that although this revolutionary information I'm about to give you is 100% free, and you're not going to be sent to some sales page after entering your email, or even have to spend one dime on this, I am going to be limiting the number of copies that I give away. If you are lucky enough to be watching this video right now, it means that I have not yet reached that number. But you need to act quickly. Enter your email into the box on the right to gain instant access and get started right away.
So in this video we're going to take a look at investing in funds, and we're going to look at one type in particular, the investment trust, and explain why we generally prefer it to its main rival, the unit trust. So as an investor, why do I want a fund? After all, I could go out and just buy shares individually, build up a portfolio of 10, 20 or 50 and manage it myself. Well, a fund of course simplifies things. I just hand my money to a fund manager in return for a set number of units or shares, depending on the investment, and then they take care of investing my money for me. And that means I have less administration. I'll pay, of course, the fund manager to do the job, and I hopefully get, if you believe the advertising, the benefit of their expertise in a particular market. The question then is, if I want to buy a fund, what do I buy? Before we kick off with investment trusts specifically, and the reasons why we tend to prefer them at Money Week to the unit trusts, which are their main rivals in many ways, what types of fund are there? Well, essentially, there are two basic types. The so-called actively managed, and the ones which are passive. And really today we're focusing on actively managed funds, and what we're saying is that although not all of them are actively managed, a big part of the industry is unit trusts, and slightly less well known are the ones we like, the investment trusts, or to give them their full title, investment trust companies. Now, active management does what it says on the tin. This suggests that I'm paying a fund manager or director to actually make investment decisions on my behalf, and I'll pay them for it. A passively managed fund, on the other hand, simply tracks an index or sector, let's say, and there are quite a few exchange-traded funds that do exactly that, or ETFs. Now, this is a slight simplification. I mean, there are passive unit trusts around, but today we're going to focus on actively managed funds, which tends to keep you over here. In another video, we'll take a look at exchange-traded funds, which are mainly trackers or passive, and some of the pros and cons of those. So, what is it about investment trusts that we think often makes them more attractive than unit trusts? Number one, cost. And that's a very important one. For investors, you don't want to be throwing away more money than you have to every year on charges. That's going to eat into your returns and eat into what your fund is eventually worth. So the problem with unit trusts is they are allowed to spend an awful lot of money on advertising, and many of them do. When you see an advert on the tube or on a bus or in a magazine, chances are, if it's a fund, it will be some kind of unit trust. And that's fine, but the problem is, of course, that that's got to be recovered somewhere. All that advertising spend, all that marketing spend's got to come out of somewhere, and lo and behold, it comes out of your money. So, although investment trust companies are often seen as the kind of inferior twin, if you like, they're not often as widely marketed because they're subject to restrictions imposed on companies. Nonetheless, charges tend to be lower. The charging structures are different, which can make it a little bit more difficult to make the comparison. Unit trusts, initial charges, 4-5%, often rebated through a fund supermarket, annual management fees, and sometimes exit fees. Investment trust companies, typically you've got the bid to offer spread on the shares, and you've also got an annual management fee. But taking all those into account, usually, for similar investment objectives, an investment trust is the cheaper option. So that's one reason why we quite like them. Number two, there is the possibility with an investment trust that you might pick it up at a discount to its net asset value. Discounts of 10% or more are quite common, and that's not something you get with the unit trust, and that simply comes down to the way that these things are priced. For a unit trust, basically what a fund manager will do is come up with a net asset value for the investments that he or she controls, and I'm going to put a random and obviously small figure on that of 100,000 sterling. So that's the NAV of the fund, derived by looking up the prices of all the shares in the portfolio at, say, the end of the day. And then the fund manager will look at the number of units in issue. So in very simple terms, let's say there are 100,000 units that have been sold to investors. And you would expect, and with the unit trust you'd normally see, that those units are worth, let's say, £1 each. So 100,000 times a pound is 100,000. In other words, this valuation is directly driving that unit price. And that's a feature of unit trusts, which means you don't have the opportunity to buy them at a discount to net asset value. But what does that mean? Well, with investment trusts, here's the point. They are actually companies, and as companies they have publicly quoted and traded share prices. And that means that £1 is by no means automatic. For example, if this is an investment trust company, the corporate director might well look up, the fund manager might look up what all the assets in the fund are worth, come to the conclusion that's £100,000 at open market value, and then, as an investor, you might look up the open market share price, because with an investment trust, despite the name, this is a listed company on the London Stock Exchange with a quoted share price. So you might look up the share price and, slightly to your surprise, let's say it's 90p. So the market capitalisation of this thing at the stock exchange is more like 90,000. In other words, the whole thing is trading, in terms of the shares that it's issued to investors, at a 10% discount to the value of its underlying net assets. And that discount is quite attractive. Buy the right investment trust company, and effectively you're going to get its future performance in terms of that NAV going up, hopefully, plus you may see the gap between its market capitalisation and the assets that it owns and controls on your behalf narrowing. So, in other words, you can end up with a nice little boost to the returns you get from the investment trust, and that's just not possible with a unit trust. And another thing we like about investment trusts stems from what I've just said, and it's this. Investment trust companies are listed at the London Stock Exchange. You can check out the share price every day, you can look it up on the usual terminals and screens and so on, and that means that investment trust companies are what I'm going to rather grandly call continuously priced. In other words, if I want to sell my shares in an investment trust company, I can do it at 11, 3, 4, as long as the market's open. Fine. It's like selling shares in Tesco or BP. I look up the ticker, off I go. Unit trusts, not true. Unit trusts are not listed. You can't buy and sell them on the London Stock Exchange. You need to get a valuation for your units from a fund manager, and they may only let you do that once or twice a day. You may have to wait for a unit valuation, and that can be a little bit frustrating. As an investor, the liquidity on an investment trust is often that little bit better. Now, as a long-term investor, you might say, I'm not that bothered, but it's another factor that just makes investment trust companies a little more open, let's say. And finally, gearing. Because investment trusts are actually companies, they are allowed to borrow, just as other companies are allowed to borrow. Now, unit trusts can borrow too, but regulations stipulate much tighter control often over the amount they can borrow and for how long. And gearing, if you pick the right investment trust company, is a good thing. It enhances returns. And here's how. Just to take that final point on gearing. Let's say we have an investment trust company and a unit trust. Make up some very, very simple short balance sheets. So, total net assets, 100,000 sterling. Total net assets, 100,000 sterling. Very simple numbers, obviously too small to be realistic in the real world, but that's fine. Funding. So, assets 100,000 in both cases. Funding. The investment trust company is 50% funded by equity. That's people buying its shares. And 50% funded by debt. So you've got assets of 100,000 funded by a mixture of shareholders and external debt coming to 100,000 too. The unit trust also has assets of 100,000, but because it's not allowed to borrow, all equity funded. And by that I mean that the money's been put in by unit holders, investors. Okay, so far so what? So what's my point? The point is this. Let's imagine that these two have a tremendous year. Assets under management double. So a year later, revaluing the net asset value, that's gone to 200k, and that's gone to 200k as well. Okay, here's the point. As an equity investor, which one would I rather be in? And the answer is the investment trust company. Because as an equity investor here, your money's been doubled. If the unit trust were liquidated tomorrow, in theory, anyone who put money in here has seen it double. Over here, even better still, if the investment trust were liquidated tomorrow, £200,000 of investment sold, £200,000 of cash, let's say, clear the debt, that leaves 150,000 down here. In other words, the initial 50,000 from last year has become 150,000, and that's a bigger return on equity investment. So gearing in an investment trust company, assuming you pick the right one, can enhance returns. The problem, of course, is the whole sector got tarnished by the split capital investment trust crisis a few years back, where of course the exact reverse happened. A heavily geared investment trust company can wipe out your capital much faster than a unit trust. So, we like investment trust companies at MoneyWeek. They often don't get the attention of unit trusts, and that's partly because they're not as heavily marketed. But the four reasons we like them: cost. Often they're cheaper than the equivalent or virtually identical unit trust. Secondly, there's the opportunity to buy them at a discount to net asset value. That's not something you get with unit trusts. Thirdly, continuous pricing makes them that little bit more flexible, that little bit more open. And fourthly, gearing. Not always a good thing, but certainly is, provided you pick the right investment trust company. Right, in this video we're going to take a look at a very important market, the commodities market. This is an introductory video, so we'll just look at what's traded in the commodity markets as far as investors are concerned and some of the key jargon. We'll also look at some of the differences between commodities and, say, shares or bonds. Many of them are obvious, but they're worth bearing in mind if you're going to invest in this market. And thirdly, we'll take a quick look at the way that commodities are traded and the way that an investor can access commodities. So, what are commodities? Well, we see them all around us. The commodities markets influence the price of a gallon of petrol every time you fill up your car, the cost of a cup of coffee, whether bought from Starbucks or made at home, the price of the electricity flowing into your house and into the office. So commodities markets matter. They have a big bearing on our day-to-day lives. But they're also an interesting opportunity for investors. First of all, some jargon. What types of commodity do we have? Most people could list plenty of commodities, but in the markets they're generally broken down into several types. First of all, you've got the metals. So you have the non-precious metals. You have the lead, the copper, the nickel, the aluminium, or aluminum if you prefer. And those metals are commonly used by manufacturers and so on. So there's a market for trading large quantities of those non-precious metals. Then you have the precious metals, and precious metals can be broken down not by what you think is valuable, but actually by the market jargon and convention. So the precious metals are gold, which we talk about a lot at MoneyWeek, silver, platinum, and the metal that you could make another wedding ring out of, but you'd also put into a catalytic converter, palladium. So those are the so-called four precious metals. And the metals are also known quite often as the hard commodities, for obvious reasons. So that's one whole group. And actually in London there's an exchange that specialises largely in trading some of these metals. Okay, we also have what some people would call agricultural commodities. And many people would call, loosely speaking, the softs. So there's a big market for buying and selling the likes of cocoa, sugar, coffee, and so on, soybeans, and so on. So those are the agricultural or soft commodities. Broadly speaking, kick one of those, it hurts. Kick one of those in a sack, and it probably doesn't, hence the language. And then over here, you've got what I'm going to call energy. So over there you've got oil, gas, and so on. So commodities, these aren't prescriptive definitions, but these labels are used quite often to describe groups of particular commodities. And each of them have slightly different characteristics, slightly different markets in terms of where they're traded, and obviously slightly different users in terms of buyers and sellers. So that's the first thing, a little bit of jargon on the type of market we're looking at. Now, before you dive into commodities, and a lot of people do like to try and play commodities, it looks like an exciting place, and it certainly is, you need to know a little bit about what makes a commodity different. Now, some of this is intuitive, but buying and selling commodities is not the same as buying and selling, say, shares or bonds, or simply opening up a bank account. So, worth bearing that in mind. You know, what are some of the key sort of features we need to look out for in the commodities market that maybe we wouldn't worry about so much if I was just buying Tesco shares? And some of these features explain in a nutshell why the commodities market isn't for what I'd call widows and orphans. It's quite a high risk place. Prices can be volatile, and that's because into the mixture with commodities, things that affect price, we've got a lot of different components. For example, features of commodities that you wouldn't worry about if you're buying shares. They can be stolen and they perish. So you've got storage issues. Yeah, some commodities you can stick in a warehouse, take them out 2 years later, they look much the same. Gold, for example, except a warehouse is probably not a good idea, maybe a bank vault. But the same can't be said of corn. Some commodities are perishable, and that means there is an aspect to commodity management that you don't get with, say, shares and bonds. Warehouses around the world specialise in storing commodities, making sure that if someone arrives with a warrant to buy X many tons of a particular commodity, the commodity is there in the right quantity and it hasn't all rotted. So that's one factor. Secondly, you've got delivery, security. Ships sink, lorries crash, things blow up. Not a problem when you're talking about the gilts market, let's say for government bonds, but definitely a problem with commodities. So, as a buyer and a seller, you've got to think about what you're going to pay to store a commodity, potentially, or what someone's got to pay, and what you've got to pay to insure it. You wouldn't normally have to insure a savings account or a Tesco share in quite the same way, but you do have to think about that in the commodities market. Next, of course, we've got politics. Commodities are volatile. One of the reasons is this. If you look at what's happening on the Ivory Coast at the moment, the Ivory Coast is responsible for around 40% of chocolate exports worldwide. So what happens there matters because it affects the supply of cocoa that goes into chocolate, and therefore, apart from the weather being an obvious factor, politics is a problem too. And the cocoa price has shot up around 12% this year already because of political problems over in the Ivory Coast. So if you're going to be in a commodities market and you want to understand what's going on, you need to start reading the news, you need to start getting interested in where these things are grown and produced. Again, not normally a problem with, say, FTSE 100 shares or gilts. And then, of course, you've got one other feature. There's no income. If you buy a share, you might get a dividend. If you buy a gilt, you might get some interest. Stick your money in the bank, you'll probably also get some interest. Sadly, buy gold and you don't. So as an investor, you need to think about that. Most commodities are not going to be a source of regular income. If that's what you want from a safe investment, this is not the place to be. So, common sense in a way, but we're just saying there are a number of factors that affect commodities that actually an investor in other markets wouldn't particularly lose sleep over. What's my point? The point is it makes the commodities market unpredictable, quite volatile, and really a market you need to kind of do some homework on if you're going to go down to the level of actually getting involved in trying to trade cocoa or silver or whatever it happens to be. Okay, so that might sound a bit scary. So I mean, in practice, how are these things traded, and how can a retail investor get some access to this market? Well, let's have a look at trading. First of all, we've got the professionals, as I might call it. So, around the world, there are some huge exchanges that specialise in trading commodities. The sort of people that use these exchanges are big buyers and sellers represented in New York, for example, or Chicago at the mercantile exchanges, as they're called, or in London at the metals exchange. So there are people interested in physically buying and selling large quantities of metals or wheat or pork bellies. But there are also a lot of speculators. So trading in the professional, if you like, the wholesale market is done through the likes of the London Metals Exchange, the New York Mercantile Exchange, or NYMEX, and the Chicago Board of Trade and the Chicago Mercantile Exchange. This is not the full list, but around the world you've got exchanges based in most of the major cities and financial centres that just do commodities. And a lot of them still do the kind of waving around that you used to see more often in London on stock exchanges. So if you want to go and see active trading, people in colourful jackets, people shouting and using hand signals in pits, these are quite good places to go looking. The London Metals Exchange, for example, is about the only exchange in London where the so-called open outcry method of trading still holds. It hasn't all been made electronic. How does that help you, though? As a retail investor, you're not about to go and become a member of the London Metals Exchange or join CBOT. That all sounds a bit inappropriate. So, for the retail market, there are two basic choices. You could go for the commodity itself. You could do physical trades. Or more likely, you're going to buy some sort of fund. People do buy gold, for example. I mean, you can buy gold coins and store them. The problem is you probably don't want to leave them at home. You want to store them somewhere more secure than that. But for most people, physically buying and selling isn't practicable. I mean, yeah, by all means have half a dozen gold coins at home, but not a ton of copper. So, in reality, most retail investors will go for some sort of fund. And there are funds around where either a fund manager specialises in going out and buying individual shares, perhaps linked to the commodities market, or you can get an exchange-traded fund. And at Money Week, we quite like exchange-traded funds. These are simply shares listed on exchange that track the price of a commodity or a group of commodities. So, for example, you can get an ETF that tracks the gold price or the silver price or individual soft commodities or even baskets of them. And these tend to be fairly simple and fairly cheap. So, for a retail investor, the most likely route is the exchange-traded fund route, let's say. But here, just be a little bit careful. Won't go into this in a lot of detail in this video, but with exchange-traded funds, make sure that the ETF, in the documents that describe it, or the fact sheet, is actually tracking the physical commodity and isn't simply backed by a handful of dodgy-sounding derivatives such as futures and swaps. So if you're going to pick up an ETF that track gold, for example, we quite like the ones that track physical gold and are backed by a holding of gold in a vault, rather than anything that sounds like it might be backed with a derivative. So, in summary, the commodities market offers quite a lot of opportunity. There are lots of different assets to trade, grouped into the metals, the soft and the energy markets. There are a number of factors you need to be aware of to trade commodities. It's not a place for a novice. You need to do a bit of homework first. And there are, in practice, many, many ways to trade commodities, a lot of which are not really open to a retail investor. So we're recommending normally that you go down the fund route. And when it's a fund that you're looking at, the best bet is to go for something relatively simple and relatively cheap. In this case, the exchange-traded fund.